My name is Neha Narula, and I'm the director of the Digital Currency Initiative, based out of Cambridge, Massachusetts, at the Media Lab at MIT. And I'm so happy to be with you here today. So huge thank you to our organizers, the Bretton Woods Committee, and our hosts, the Federal Reserve Bank of New York, for putting this on today and bringing us all together. So I'm joined by some very impressive panelists. So you might remember him from the last panel, Bill Dudley, who's going to be a participant this time, so we'll get to hear a little bit more from him, the chair of the Bretton Woods Committee. Nellie Lang, Undersecretary for Domestic Finance in the Treasury. Per von Zelowitz, the director of the New York Innovation Center here at the bank. And last but not least, Gordon Liao, who's the chief economist at Circle. And this panel is really going to focus on innovation. So central banks have an incredibly important role to play in our financial system. Central banks provide the core stability, a public good, which helps facilitate innovation on top of the layers that the central bank provides. But central banks also have a core responsibility to focus on financial stability, to protect it, to preserve it. And sometimes those two things can be very much at odds, which we're going to get into today. So this panel is going to talk about the impact of digital innovation, and this is an incredibly timely moment for us to be having this conversation, because just a few weeks ago, one of the world's most successful companies was destroyed, almost destroyed, when there were certain concerns at its highest levels about the danger of a specific technology. So I'm talking about OpenAI, of course, and what they went through. And it's so interesting because we've gotten to a point where everyone needs to have a personal opinion on how likely it is that a certain technology, AI, will destroy the world, or also known as your P-doom, your probability of doom occurring. So if you don't already have this number in your head, it's something to think about for the future. The most worrisome part is that, unfortunately, for a lot of AI experts, this number is non-zero, or at least not close enough to zero for my preference. So I think it's important to remember that technology is never all good or all bad. It completely depends on what we do with it. And it presents new risks and opportunities. So I'd like to start by turning to the panel, and feel free to jump in or sort of to raise your thoughts. But what concerns or excites you the most when we talk about digital innovation, when we talk about technology and central banking and our financial system? So who would like to kick us off?
So I mean, I'm going to be very brief because you've already heard way too much from me today. I think the interesting part is how you can actually reconfigure how we do things. You know, in other words, different business models can be basically facilitated by new technologies. And so I think, in my mind, that's where I'm interested in where digital finance is going to take us. Not because of the digital finance piece itself, but how that allows you to rearrange how you do businesses. That'd be number one. And number two, I just feel like there's a whole bunch of low-hanging fruit in terms of areas where we can do a lot better. We talked about in the previous panel, cross-border payments, wildly inefficient today. We can do that much better. Trade finance, securities settlement. There's a whole bunch of areas where the system is pretty clunky. You can't do things on an instantaneous real-time basis. If you can do it on an instantaneous real-time basis, you can take out not only costs, you can make it more efficient, but you can also make it safer.
Let's see. So risks and opportunities. So there's clearly just huge opportunities from some of the digital innovation. And I'm going beyond just AI, but even just some of the digital assets, the potential for tokenization, the low-hanging fruit that Bill mentioned of infrastructure that could be modernized. Just basic infrastructure, settlement, cross-border payments, et cetera. I think I would, just to round out the conversation, of course, there's always risks with new digital, and any financial innovation. And I think the digital innovation is just part of a spectrum of innovation that we've seen over decades that have kind of changed the way financial services can be provided. But I don't think we have to take a new approach. I mean, there are some foundational principles for regulation. You want consumer protection, you want investors to be protected. There needs to be safety and soundness considerations. There needs to be considerations for illicit finance, anti-money laundering. And then there are financial stability considerations. And I think there's a lot of opacity. And that's something we can talk about later, but I think there are approaches. We have the foundational approaches to regulating this. This could be faster, more complex, more data intensive, but it's not fundamentally, foundationally new. So I'll just stop there.
Thank you, and I'll start by expressing that the views that I express today are my own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System. And having that out of the way, I would add innovation is really about doing new things better. So finding new ways to create new value propositions and improve on the current state. And as Neha said, there's no all good or all bad. Every new technical design, every new technical architecture, every new technology both has risks and opportunities that are incumbent with it. And the process of innovation is really about discovering what those are and ultimately the balance of those two with the goal of delivering a positive net benefit, a positive value proposition at the end of the process. So I'm an optimist. Things work today. Some things work well. Some things just work. But there's clearly tremendous opportunity to do things differently and better in many areas than we are today.
Thank you so much. I'll start with the opportunity side and go on to the risk side. I think opportunity side from my perspective on digital finance is both in the payment space, but also in the intermediation space. In the payment space, at least on the private sector side, we're seeing just enormous demand for adoption of things like payment stablecoin. So Yigang earlier said some numbers for e-CNY project. I'll cite some numbers for payment stablecoin, or stablecoin as overall as a instrument has grown to about over $120 billion, mostly dollar-based stablecoin. And that's about 5% of physical cash in circulation for the US. Now it's quite different in many ways. It is, today I could send money from one mobile device to another mobile device, cross-border, cross-jurisdiction, in a fraction of a second, under a fraction of a cent. That is innovation in its form of faster, cheaper, and perhaps better payments. On the intermediation side, I think it's really important to focus on what these technologies could bring in terms of reducing the amount of intermediation risk, including reducing the amount of concentration risk in certain sectors. For example, the innovations in automated market making today allows the trading, mostly of cryptocurrencies, to have deeper markets than central limit order books. Now imagine applying the same technology to foreign exchange or to treasury trading. I think that's the type of adoption that could change intermediation for the better. Now I think the risk is also equally important to consider and should not be understated. The biggest risk to me today is the lack of US federal regulation and also the proliferation of unregulated digital asset activities offshore. I think we have done some work, especially last week with some of the enforcement actions on some of the offshore exchanges, but there's still a lot to do. Now, on the payment stablecoin side, as I mentioned earlier, it is a growing demand, but the vast majority of it are issued by issuers outside of US without any US rules to follow. But I'm optimistic and excited about the opportunity because of the adoption we've seen, not just for speculation, but actually for use cases, for everyday use cases. So another number aside is, over the course of the last 5 years, initially stablecoins started out as a trading instrument for crypto. But in the last 5 years, the amount of speculative activity per dollar worth of stablecoin actually declined by 90%. Now the trading turnover per dollar worth of stablecoin is actually lower than the amount of trading activities even compared to M2. So quite excited about the opportunities, but also concerned about some of the risk that I'm sure we'll cover more.
Well, yeah, thank you for bringing that up. And I think we'll talk about regulation in a bit. So put a pin in that and we'll come back to stablecoin regulation, which I think is an excellent example to kick us off when discussing regulation. Before we turn to regulation, I want to talk a little bit about this phrase, public-private partnerships. So I've often heard this phrase brought up and used. I think, Bill, you brought it up last night about how important it is to have public-private partnerships when exploring new regulation or new technology or new systems. Often heard it used when discussing digital assets and central bank digital currencies. But I think we're lacking a bit of specificity here. What does public-private partnership really mean? How do we actually create a structure that is effective and that can actually bring forward safe innovation? So maybe, Bill, I'll start with you, and then I'll turn to, I don't know if Per or Gordon, you might have something to chime in on here. So Bill, why don't you go ahead?
So I guess I think the public-private working together is really important, but I'm not sure I agree with the notion of the word partnership, because that implies that there's sort of common goals, and there aren't common goals. I mean, the private sector is looking for profits, the public sector is looking for stability. And so they both have different goals in mind. So I think when I think of it, the role of the public sector and the private sector, the way I think about it is like this. The public sector should basically set the rules of the road. Like, here's what a good stable coin needs to be able to do. Here's the kind of stresses it must be able to handle. If something goes wrong, there needs to be a phone number I can call to figure out how to remediate the problem. So the public sector sets the rules to essentially protect the citizenry, make sure that a bad stable coin doesn't drive out the good stable coin. And then the private sector's role is to operate within that framework, as opposed to outside that framework, and innovate and run a successful business. So you might call it a partnership. I view it as more of a, you have to work together to achieve a common goal of a dynamic, innovative system, but that also has the appropriate guardrails.
So my experience talking to people in the digital asset space is one of extreme frustration in this area. So they would say the rules of the road have not been, I don't want to put words in their mouth, obviously, but I don't think too many would disagree with me. They would say the rules of the road have not been sufficiently defined, and that the message from regulators has been, well, the rules of the road are clear. Go follow the rules of the road. And they don't, there's some kind of disconnect happening here. So maybe Gordon, with stable coins as an example, do you feel like those rules are clear? Or do you want more rules? Do you want fewer rules?
We're definitely hoping for federal level regulation on payment stablecoin. And the reason for that is both because right now the payment regulation space in the US is quite fragmented among mostly different state money transmission rules, but also for international coordination issues. As Vice Chair Michael Barr said over the summer in one of the testimonies he did, he sees stablecoin, or the Federal Reserve sees stablecoins as a form of money. And of course, as a form of money, you want to preserve the singleness of money. And to do so, I think that requires public-private partnership, or at least understanding of what's needed. For instance, access to a settlement account at a central bank to allow efficient settlement, even in a limited sense, could significantly improve the risk profile and reduce the counterparty risk that payment stablecoin issuers face. I think those are areas in which just establishing common understanding of what is needed for safety. And by the way, I think the goal of private sector is not just to seek profit, but also to seek stability as well, and to improve overall the financial system. But I think having those understanding of what is actually needed from the private sector perspective, what rules needs to be in place to ensure their safety, those are the type of conversation that needs to happen at every single level with every single type of public-private sector institutions. I also see, there are examples of green shoots, examples of research explorations that I'm sure you'll speak about, but projects like Project Mariana, for instance, where it's taking private sector innovations in automated market making and testing out with central banks. I think those are also just very exciting type of partnership or opportunities or collaborations.
Yeah, regulation is definitely not the only way. Maybe Nelly, do you want to sort of chime in on ways the public sector can sort of set these rules or guidelines, or in other ways work with the private sector? How do you think about that?
Yeah. So let's see. So setting the guardrails is so important. I think when you have innovation, say like digital or AI, the potential for change is so big that I think it's important to suggest there's an iterative process. So in AI, for example, the potential seems like it's hard to know, and I don't think anyone can know. But so you set, both the president with an executive order and NIST setting safe and responsible standards, but they're going to start at a pretty high level, until they sort of learn a bit more and interact with the private sector, who will be sort of the engines of development. They can be more nimble and flexible. There will just be this very interactive process. So there's that, I don't know if that you call that partnership or just this, there's an active, necessary role for the public sector in this, aside from regulation. I think those are like just sort of global standards for safety and soundness for the economy and the global system. On regulation, just to pick up on stablecoin, it's not for lack of trying that we don't have a regulatory framework for stablecoins in the United States. We put out in November 2021, so that would be 2 years ago, a proposed framework for regulating stablecoins in the United States as a payment mechanism. There are some issues for stablecoin as trading, and there's legislation for how to make crypto exchanges provide more safety and provide consumer protection and investor protection, reduce conflicts of interest and all that. But stablecoin as a payment mechanism, it relies on singleness of money, trust in the value of the asset, the reserves that are backing it, trust in the transfer mechanism to make it actually function as money. And we've provided, worked for a couple of years on potential legislation. I'd say in Congress, there's very mixed views on basically the value of digital assets. There's a faction who believe it doesn't have a lot of value and regulation gives it legitimacy. And then there's a different group that believes that regulation and innovation are not, inconsistent. Regulation should foster innovation and just try to keep the guardrails on, and without a prejudged view about whether in a future payment system stablecoins will still exist or not. It's just if they're going to be developed, you should have some guardrails. So we have proposed legislation that would put some restrictions on the assets backing the stablecoin, some guardrails around how they're held around the custodial wallets, and also just potential, the fact that because it's a payment mechanism, it could, the network effects of money could allow it to expand very quickly. So you want to be able to, capture, be prepared to consider that if it becomes money, it could expand very, very quickly. So we've been working on it. And the FSB did issue global recommendations for stablecoins, for global stablecoins this summer, and is working with countries to implement those standards. The US is not yet compliant, I would say, but this is about expanding to within the G20, but many of these are domiciled in non-G20 countries, and so trying to get regulations and implementation and adoption in those countries is important. I just mentioned one other thing. In addition to the stablecoins, we've supported market structure legislation. Intermediaries, these multi-asset crypto intermediaries, they should have rules around conflicts of interest, all the sort of same investor consumer protection rules that have existed for other kinds of trading, other securities and commodities, so we're for that. And then last week, maybe this week, we've asked Congress for, in a letter, not proposed legislation, for additional tools related to illicit finance. There has been unfortunate use of crypto, some stablecoins, some unbacked, for financing terrorist organizations. Cash is still used, so it's not like crypto is unique in this. But we did ask for some additional authorities, secondary sanctions, and some extraterritorial abilities to, so stable coins domiciled elsewhere, targeting the dollar, that are back to the dollar, could Treasury have some authority there? So
just to dig into that
yeah.
just a little bit, I mean, I don't think regulation should lead necessarily, right? I mean, it should follow what's, it's not going to be at the cutting edge. It needs to come later. Why do we need, when you mention new regulation for intermediaries, crypto intermediaries, why aren't the existing ones sufficient? Is it a question of being able to apply them in a different, more international context, or is it that there really is something different about this technology that requires something new?
Yeah, so I think, so the approach to the regulations on digital assets were, what existing rules and regs apply, and can you enforce them? And clearly some can be enforced. Some apply and some are enforced, just looking at the Binance kind of action the last couple of weeks. But there are gaps because some of the ways these new intermediaries function, and I'm calling them intermediaries, and Gordon, you probably want to correct me here, but all the payments, settlement, everything's done together, and all the rules are written around all these functions being done separately. And so how do you keep the conflicts of interest arising between all those things? So that to us was a gap in the current rules. And so the idea was, how do you write the new rules to address the way some of these transactions are going to get paid, cleared, and settled? So that would be an example.
Yeah, the problem is that a lot of the existing regulations were written for the prior
Exactly,
structure.
yes, exactly.
And so they're not really fit for purpose
Exactly,
for new structures.
But you always look to see what applies, and then if it doesn't apply, what else is needed, and go that approach.
I think I applaud the effort, especially on the recent proposal that the Treasury put out, because many of the rules do need upgrading. Even setting aside crypto, like the BSA rules, it's significantly outdated given today's even just transfers of funds through the banking system, corresponding banking system. So I think some of the rules that are proposed could be a way of just bringing in unregulated activities into the regulatory parameter, and also through the process establishing safety and soundness and trust, and also establishing consumer protection. And I think it's very much needed.
Well, I want to move on towards coordination, because I think rules and guidelines and regulations are certainly one place where global coordination might be helpful or necessary. But I want to speak about coordination broadly, because coordination can often be very challenging and very overhead intensive. And so where are the most important areas for central banks to think about coordination? And I'm also curious where you see the most effective coordination happening. What are some examples where it's really working? So Per, maybe I'll start with you, because you're running the New York Innovation Center here, which is a collaboration between the Federal Reserve Bank of New York and the BIS Innovation Hubs, and the BIS obviously serves as a global coordinator for central banks. So maybe you could talk a little bit about that.
Thank you. And in fact, piggybacking on some earlier comments that Bill made, when we think about things like public-private partnership, we don't really use the word partnership either. We focus on collaboration. And I would focus on that concept also to answer your question now. So as you referenced, one of our key relationships is we have a strategic partnership with the BIS Innovation Hub, the Bank for International Settlements Innovation Hub. They're the BIS's innovation unit that focuses on conducting technical research and experimentation across a number of themes. So we have a very similar model at the New York Innovation Center here at the New York Fed. Our focus is on conducting technical research and experimentation. So while we're not a policy group, we're not economists, we coordinate with many colleagues and subject matter experts in those areas in order to ensure that we have those perspectives considered in our experiments, but also so that the output from our experiments can ideally inform some of the thoughts of our colleagues who are focused in those areas. Using the examples of the New York Innovation Center work, all of our projects rely on this model of collaboration. So we don't work in isolation. Innovation, I don't think, works well in that regard. You will not produce effective results if you have certain innovation goals. If you're working in isolation, you have to work with others. I always cite a funny anecdote. Bill Joy, who was one of the co-founders of Sun Microsystems, always said that the smartest people in the world always work outside of your own organization. So to do really good work, you have to find ways to pull those people in and work with them. So this is called Joy's Law. And I'm a big believer in Joy's Law. And that's an aspect of our model. So examples of how we collaborate with other central banks. We've published earlier this summer the results of one of our research projects called Project Cedar 2 in Ubin Plus that was in coordination with the Monetary Authority of Singapore. This was focused on validating a cross-border payments use case. So as Bill referenced, lots of opportunity to do things better within that domain. We also published another report recently for a project called the Regulated Liability Network that was conducted in collaboration with a number of private sector organizations, bank, non-bank financial institutions, tech vendors, a law firm that was focused on validating whether we could design an independent infrastructure that would enable the exchange and settlement of regulated forms of money, of tokenized money. So these are examples of how we're collaborating both with central banks, but also more broadly with the private sector. All of the projects that we conduct will follow this model of collaboration. We have new projects that are underway now that are not public yet, that we haven't published the results of, although we will later next year, that are in collaboration with the BIS Innovation Hub and then other central banks via the BIS Innovation Hub.
Yeah, no.
Can I, two examples of different kinds of collaboration. So in addition to the technology, which is critical. So an example of cross-border payments, collaboration is needed with the technologists, but also the central banks who oversee the payment system. Technology isn't going to solve the governance problems, the FX problems, the membership criteria, all those issues that come up with any kind of cross-border payment platform. So you need both. That's a different form of collaboration where you need sort of the policy and the central bankers and the technologists to be working together. Another example just to raise is related to the collaboration between Treasury, or the Ministry of Finance, where I sit now, and the central bank. So if we think about CBDC, for example, the central bank clearly it's a liability of the central bank, and the central bank will likely be the one to make that decision along with Congress as to whether it wants to issue one. And it's related to its function as money, to payments, to the way financial credit is provided in the economy potentially, and financial stability. But from the executive branch, there's a number of issues that come along with CBDC. I mean, it's very much changes the way money functions in society. So there are concerns related to the role of the dollar in the global financial system. That's an important issue. It relates to national security issues and the role of sanctions and correspondent banking. That will be. And then there's just basically an accountability to the public for use of on data privacy, data security, whether it can enhance financial inclusion. Those kinds of issues are very much sort of outside the basic remit of the central bank, and maybe they don't want to get deep into all those issues. So that's a collaborative effort that I think is necessary for something like that kind of innovation in our society.
You asked the question, are there any examples of these kinds of collaborations that have been successful? I think following the great financial crisis, there are two examples that I think are sort of noteworthy. The first was that there was a decision that we're going to centrally clear over-the-counter derivatives, and that had to be done through financial market infrastructures. Well, that meant that financial market infrastructures had to be much more robust. And so what happened was in Basel, the committee, the Basel Committee on Payments and Market Infrastructures got together with the ASCO, the securities regulators, and basically came up with a set of principles for financial market infrastructures. It wasn't like how they have to do it, it's what they have to be able to achieve. In other words, what are the standards of a good financial market infrastructure? And then it was left to the individual countries to figure out how to do it to achieve those outcomes. So the international community focused on what are the goals and standards, but left it to the individual countries to figure out how to do it. And then the IMF was recruited to actually examine whether the countries were actually carrying this out successfully. Now, obviously, we're not going to know for many decades how successful this has turned out to be, but we've gone through a lot of stress over the last 10 years, and the fact is financial market infrastructures have held up extremely well. So that is a way of sort of proceeding.
It's a good example.
Another example is LIBOR, the conversion of reference rates to, that was a project that had to be done around the world to get to a much more robust set of reference rates. Again, that was done, started at the BIS and radiated outward, and lots of different countries were involved in that. And we just finished the job sort of this year.
Were there lessons to learn from that? Anything come to mind?
Well, first of all, you have to develop a consensus of views that something is needed to be done here. So first you have to convince people that there's a problem if we don't act, that's worth the investment. And obviously, if you're going to clear central over-the-counter derivatives through a central exchange, that means that you're relying on that a lot more. So that created the motivation. LIBOR, we obviously had the example of what happened if you don't fix it. So I think there is, it takes a bit of time to develop the consensus that the effort is actually worth it. But I think in the case of central bank digital currencies, crypto assets, stable coins, enough development has already taken place that I think it's pretty clear that there is a future for these things, and so that there is a need for this kind of coordinated response.
Great lead into my next question. So I was going to sort of separate out discussion of digital assets, because this is not a digital assets panel, it's a digital innovation panel. However, it's already come up several times. So forgive me for asking this question at this point, but maybe we'll just go down the panel, and I want to ask you, digital currency, digital assets, is this a paradigm shift? Is this a groundbreaking new technology that's going to change the way we move money and value, or is this a distraction? And a lot of people come up to me and say, I'm a crypto skeptic, or I'm a digital currency skeptic, and I say that's totally fine. I'm happy to talk to you about this. So I have predictions in my head of how you all are going to answer, but I'm really curious to see how this goes, and I want to start with Gordon because hopefully we can all predict how Gordon will answer.
I certainly don't think it's a distraction. Right? I used to be at the Federal Reserve Board and completely changed my career to jump into the industry because I do believe there's real innovation here that could, in the end, drive value for society. And I do think that there could be coexistence between multiple forms of money. Today, if you think about M2 broad money, 90% of which are privately issued, mostly by commercial banks, but some are held in different forms. And then, of course, you still have the core 10% that's in the form of central bank reserve and cash in circulation. Of course, it's possible that some part of those cash in circulation could be digitized, but I think it's not an either or, CBDC or tokenized deposit or stablecoin discussion. Rather, I could see a world in which all of those could coexist and serving different purposes, having different properties, but hopefully sharing that singleness of money. I also do think one thing just to kind of piggyback on the coordination point earlier, I think coordination is actually needed to drive these sort of adoption. We've seen what happens if you have lack of coordination in things like liquidity management, in which leads to liquidity ring fencing. I think the same promise, all the promises that we discussed of digital innovation, especially on the blockchain space, I think a lot of those could not be realized unless you have passportability of rules and coordination of what liquidity means. And so I'm quite excited.
Okay, Per, turning to you. Paradigm shift or distraction?
Well, I certainly don't think it's a distraction, although one could argue that I'm distracted all the time by all of the new things and news that's coming out. And I think whether it's really going to make a significant impact or be more incremental is also still too early to tell. So what I think is important to reference is that even though there's lots of activity in this space now, There's some focusing on CBDCs. There's some numbers that indicate that there are more than 100 CBDC experiments or projects of different levels of fidelity around the world. There's many more than that in the crypto space. So lots of activity. What that activity ultimately is leading to, what sort of impact that's leading to, is still really uncertain at this point in time. So we can look at the data, we can look at the activity, and then try and extrapolate what does that mean. And I agree with Gordon's comments. I think that there could be a future where there are multiple forms of new instruments that are regulated, that exist, and they're available to various users based on their risk profiles, based on the use cases that they're targeting, based on the value proposition that they want to achieve, that they want to deliver. And I think that sort of future is possible with this. Although again, at this point in time, I think it's still too early to tell with any level of certainty exactly what that will look like. But I don't think there'll be a big bang. I don't think there'll be one new instrument that replaces others, or one new infrastructure that replaces many others. I think there might be a new heterogeneous world that we live in with a multiplicity of instruments and infrastructures.
I think same answer, but I'll just add one element to it. So not a distraction. If it's different forms of money, it still, though, needs to be like money, and central bank needs to be behind it. I guess I would say I don't think CBDC is inevitable. Just put that out there. I think there's a need for a real-time wholesale settlement asset, but I don't think that has to be CBDC. So throw that out there.
Yeah, I agree with Nell. I mean, bank money could be good enough. If people view it as safe, sound, secure, why do they need a central bank digital currency necessarily? I'm very much aligned with the rest of the panel. I think let's run the race, but let's run the race with appropriate guardrails, with a level playing field, not just in individual countries, but sort of on a global basis. Because if you don't do it on a global basis, the activity is going to migrate to where the regulation is the weakest. And let's run the race, and then we'll see what happens. You can't really tell where innovations are going to lead at the beginning of the process. You only see it with clarity looking backward. I mean, it took 20 years, 25 years for electric power generation to actually lead to, mass manufacturing production. And so it wasn't like electricity. Oh yes, now we're going to do, we're going to have the Ford River Rouge plant. No one foresaw that development at the very beginning of the process. So I think it's really too soon to say. But we got to make sure the race is run in an appropriate, fair and thoughtful way. Because if it's not run in a fair and thoughtful way, the result you have may not really inform you well about what actually the potential was, what you miss out on by not having a fair race. And so I think having a fair race is the only way we're going to answer that question in a way that increases the likelihood that we'll actually receive the most amount of benefits.
Mm-hmm. Yeah, I think that's a really interesting point, which is that you don't know what the end point is going to look like. You really can't predict it as you're going down this path. And that's why I'm so surprised that there are so many people who just want to dismiss everything in this bucket entirely. And I think that is very, very, very premature and very risky. I understand the inclination. It is very annoying to have to try to understand deeply all of these very different technical areas and to get your head around it and to try to become an expert, and it's too much. But I think dismissing it wholesale would be premature. We don't know exactly how this is going to turn out, but there are parts of it that are not going to go away and are going to have, I think, a lasting impact on the structure of our financial system. One thing, so let's get into central bank digital currencies a little bit. Just given the expertise we have on this panel. So in the previous panel, we really talked about monetary policy. And I think the point that was brought up around interest rates is actually emblematic of something else, and something we're seeing here in the United States, as the political machinery gets going for the next presidential election. But we're also seeing it even in Europe as the digital euro starts to take hold, which is that people expressing concerns about what a central bank digital currency might mean, what type of control that might enable, and in general about their digital data being collected. So, I'm curious to hear what you think about about this concern that I think is rising and is not going to go away. Something like money requires such faith from the public, requires such trust. It really does. And obviously, our institutions work to be worthy of that trust. But how do we think about this challenge with central bank digital currency? And even if it's not specifically central bank digital currency in general, it might be the private sector, digital payments becoming more prolific.
So I think in terms of the answer to that question, it really depends on design. And so there are design choices one can make with central bank digital currency. Yigang talked about one of the design choices where basically you make sure that the central bank is the wholesaler and the commercial banks and the other financial institutions actually run the customer accounts. And by doing that, you basically don't give access to the central bank doesn't have access to all the PII data of the individual customer. So if you design it properly, you can solve some of these concerns.
Well, I think there's a concern that people don't believe that.
Well, I think then I think you have to explain that that's how it's going to be, and that could definitely impede take-up. I mean, there could be a part of the population that thinks that Big Brother is now watching over you a little bit more closely because of through this central bank digital currency, and you might explain all the reasons why that's not true, and not be believed. I mean, it's possible. I mean, there are people that believe in conspiracies. I've heard.
Yeah, I think one easy solution of that is, you can strictly innovate on wholesale CBDC, that just make it clear it's for wholesale, and then the retail wouldn't have to overcome that trust issue because it's used for wholesale. But to me, like the bigger issue with if CBDC does take up in a large way is that what would it do to the balance sheet of central banks? Central bank digital currency is a liability of central banks. We've been trying to reduce the balance sheet for the last couple of years, and the pandemic actually increased the balance sheet, and now we're trying to reduce the balance sheet again. The demand for transactions on a network is also a demand for reserve. How do we actually square, the importance of reducing footprints of balance sheets of central banks at the same time expanding the payment usage? So I think that's a fundamental issue of how far could central bank digital currency go.
Well, that's another design choice. Does the CBDC earn interest or is it non-interest bearing? If it's not interest bearing, it's primarily a payments mechanism. If it's interest bearing, then it actually can disintermediate the banking system in a pretty significant way. So again, the outcome depends on the design choices that you make.
And I would add, I think this discussion is a good example of the fact that at this point in time, there really is no consistent definition of what is a CBDC. So there's a lot of discussion about what it could potentially do, but at its fundamental basis, a CBDC is a piece of software. And with that piece of software, you can program it in many, many different ways and apply many different features, ultimately depending on exactly what you're solving for, what type of problem you're trying to solve with the CBDC, what type of value proposition you might want to deliver with the CBDC. And again, there's no consistent view on exactly what that is at this point in time. There are different definitions. So the BIS has a definition of what a CBDC is. There are many experiments that are being conducted today, proofs of concept of different levels of fidelity that are defining it from a technical perspective or defining use relative to specific jurisdictions' policy goals or other goals that they might have. But again, there's no consistency relative to that. So what's critical, I think, in this discussion is to agree on what are we ultimately solving for with this new instrument. What are the goals that we have? And those goals will be unique based on jurisdiction, based on use case, whether it's retail, wholesale, whether it's focusing on cross-border payments or some other use case. And that level of detail ultimately will indicate exactly what the features might be, and then what the risks are, what we might need to solve for to address those risks and ultimately make it useful on a net basis.
And the starting conditions matter. Different countries may make different choices based on where they are today in terms of their payment system and how financial intermediation works.
Just pick up on something you said, Neha. It's very complicated, and there's so many design choices, and there's so many different policy objectives. So some of the early advocates of CBDC were to reduce the cost of payments, make it accessible on the mobile phone, to expand financial inclusion, to meet the needs of all the underbanked and unbanked consumers in the US. That's a very different CBDC than I think what we've been, in some sense, talking about at the wholesale level, two-tiered, wouldn't change the current intermediation structure. This all gets confused in the public discourse, and it's very, it takes a lot of effort, and investigation to understand. And I think the U.S. isn't quite ready to make decisions on this yet. And we've been advocating for that the central bank, however, should be fully engaged in the experimentation, the research and design, the exploration, to be part of the conversations globally on how to design a CBDC, the technology. But whether or not the US should adopt a CBDC, I think is kind of a decision that's a few years away.
Yeah, I do agree that it's been unfortunate, sort of the binaries that have been put into play here, when really, design choices are a spectrum, or a continuum. And so, we can all agree that we want settlement to be better, to be faster, to be more efficient, to be cheaper. And it's a bit annoying when you have to assign a label to it. I actually remember having a conversation with Director Mu from the People's Bank of China, and he shared with me that they had gone back and forth on whether to call the ECNY a CBDC or not, and they had switched back and forth many times. Governor Gong can correct, Governor Yi can correct me if I'm wrong on this. And I remember being so surprised. How could they possibly have gone back and forth so many times when they hadn't changed the design? And so it's really interesting to hear that was a label, that was part of a bigger system and a bigger type of innovation that they were trying to do. So I found that very influential. Okay, to kind of get towards closing, I'm not exactly sure how much time we have, given that we started a little bit late. Great, okay. Before we jump to Q&A, but for the audience, start to think about questions that you'd like to ask the panelists. Before we jump to Q&A, I want to ask the panelists one more time to go down the line and to do something that I'm often asked to do, being part of an innovative lab at MIT, and now I'm going to turn it to you, which is predict the future. So what do you think the future of money and our monetary system is going to look like in 50 to 100 years? So really go out there. First of all, does cash still exist? Does the central bank still exist as an institution? What do things look like, And I'm going to start with Gordon, because he looks like he's ready to answer this, and everyone else can think.
50 to 100 years is a long time, but I do think the current innovations happening in AI with better processing power, happening in blockchain with more transparency and programmability of money, I think that's going to lead to better contracting. You can get to hopefully get closer to the first best contract theory perspective, that is reducing information asymmetry, also reducing moral hazard by programming things into contracts. Now, what does that lead us? I think that leads us to basically more stable financial system. And hopefully, it's my hope that the Fed could focus on its dual mandate instead of being also distracted with having to deal with financial stress every time by expanding its balance sheet every time something happens. So that's my sincere hope and where I see the technology going.
Well, my crystal ball is no more clear than anyone else's, but I'll posit my view. And as I referenced earlier in the discussion, I'm an optimist. I think a lot of the innovation work that's taking place today really is going to lead to net benefits for users at an institutional level and also individuals around the world. And of course, it will take time. And over that journey, Neha, as you referenced, there's lots of unknowns as you go down the path. But I think over the long term, we are moving in a positive direction, and new developments, new technology innovation will help lead us there. I also think it's a future that includes really a vastly heterogeneous universe, as we referenced before, and I think that's a good thing. There'll be a wide range of regulated and unregulated forms of money and securities which are available to people for use based on their risk profiles, based on different use cases, goals that they might have. I think with increases in processing power, there'll be also the ability to actually move towards this concept that we have of instant payments and instant financial services, which is a term that's always used, but nothing is truly instant today from an actual sense, but I think we'll continue moving in that direction. We also talk about these concepts of embedded finance, where the capabilities of financial services are not necessarily resident in an institution, but are actually distributed and available, again, on a much more individual basis, whether it's institutional or individual basis. So I think these are concepts that may exist in the future based on some of the direction that new technologies are leading us at this point in time. But again, who knows if my crystal ball is clear or cloudy.
I don't know if it's 10 years or 20 or 50, but so very excited about the idea of shared ledgers and tokenization of financial assets. I think that in the near term that would be in the 10-year range. I think we'll still need central banks. I think we'll still have financial intermediaries. On the just the negative side, I'm very optimistic about the potential for this innovation. But there is this huge growing reliance on data from all kinds of sources and importance of securing data, data privacy, protections, all that. And a very big growing reliance on, right now, a few providers of that. And I think that's something that the financial sector is going to have to address, like cloud service providers, third-party data vendors, all that. That's as we, all this innovation comes from more computing power and more data. And so we got to figure out how to, ensure that reliance can be, built on and trusted.
I think there's going to be a lot less friction in the system. I mean, the spending on financial intermediation as a share of GDP is still really quite high relative to what you can imagine it could be with the proper implementation of technology. And we still are operating with a lot of legacy technologies in place. Let's be very clear. Anybody who's gone to a big commercial bank and tried to move money from one account to another understands what I mean. So I think a lot less friction, a lot more safety in the sense that there'll be one source of truth. You won't have to worry about the asset being owned by two different people, and much less settlement risk. I think everything will be pretty much instantaneous, and so things will get transferred. There won't be any risk of things moving from A to B, quite seamlessly. So I think there's a tremendous scope for improvement compared to where we are today, and that's why I'm optimistic that this is actually going to take us in a pretty interesting place.
Great. Wonderful note to close the panel on. So let's move to questions. I think we already have several lining up. So
with a merchant, I have a right of set-off against the credit card company if the merchant doesn't settle up with me appropriately. So if I paid with digital currency, I would lose that protection. How will the digital currency models give me back that protection?
Thank you.
I guess that question is for me. That's a good question. I think the technology space is constantly innovating and new solutions are coming about. Just yesterday, I think my colleague and I, we released a white paper on recoverability tokens, which is a concept that there's ways of recover token transactions so that even though it's instantaneous for the first part of the settlement, but it's more of an escrow account that you could claw back. So that's one way of resolving the issue that you just mentioned. Of course, this still requires, and this is why I don't think intermediaries are going away, you still need third parties to verify, is it a fraud transaction? Is it a valid transaction? But I think the technology is just evolving so fast, we can certainly address those problems. And we proposed a solution just this week.
Also, I will selfishly point you towards an article that my group wrote in collaboration with PayPal on this topic of chargebacks and digital currency. So, you can still do chargebacks on top of digital currency. It could use the same structure as what the credit card companies use today, requires intermediaries, or sometimes the technology does offer new mechanisms, like Gordon pointed out, escrow. So this was written for OMFIF, if you want to look it up.
Morning, everyone. Thanks for the insights, number one. If you would, I'd love it if you could go back. I know we joked a little bit about it on the subject of kind of the trust issue and the breakdown of trust, but it seems to me whether or not we do go CBDC or we have a normal progression of the current system that we're in, We have major issues right now societally with trust, and as that being the social contract being so important, I'd love to get your takes with a little bit more detail. And Neha, based on where you sit as well, I'd love to get your thoughts also on that subject, because I do think that's one of the biggest ones we have to overcome right now.
Does anyone want to chime in?
I think everybody up here, I bet, agrees with you that trust is actually the core necessary ingredient to have a efficient payments regime and efficient financial intermediation. If you don't have trust, the system breaks down. I mean, we saw that in spades in 2008.
Yeah, I'd echo that. I mean, a lot of our financial system is built on fundamental trust in something like a dollar being worth a dollar tomorrow. And when that breaks down, that could have dramatic effects. The advent of technology can make that type of breakdown happen faster than it could before. That's what we saw in March with Silicon Valley Bank. That was a breakdown in trust. And I think that the door isn't closed on those types of situations, and there is a certain speed that is possible now that was not possible a few decades ago. And so that's the real challenge I think that we have to deal with. There was always risk to trust, but now that trust, if trust breaks down, it can happen at a scale and speed that was previously unprecedented.
Whether or not there's a room in the innovation kind of setting that we're talking about, that you're actually seeing innovation helping to aid the notion of solidifying trust, what we have left of it. Yeah.
Well, I think you're always going to have the trust in the central bank is always needed for preserving monetary value as monetary unit. But the technology could help in many ways of just verifying transactions through public blockchain, for instance. That's one way of overcoming some of the settlement issues and settlement trust. But I think we do need to trust in that a central bank can keep its mandate and maintain reasonable inflation and maintain the stability of monetary value. So that's, I think it's two different types of trust that needs to be done.
European American Chamber of Commerce. I want to pick up on what Undersecretary Lang said about the dependency on service providers to help keep the machine going on this, because I think it's also a trust factor. But what is being done in that regard? I mean, there's a lot of innovation still necessary to, in the data centers, in battery, computing power. Is this an opportunity for partnerships that were mentioned earlier, or what is being done in that space?
So there is work, and some of it through G7, some of it domestic, on the resiliency of third-party service providers, mainly cloud service providers. Some of that work is being done through G7, I'm quite sure. In terms of the, AI, with the addition of AI, there's some concerns about AI-related cyber risks. And the executive order that was issued just, say, a month ago has asked the Treasury to focus on, are there additional considerations for operational or cyber risks of third-party service providers related to AI? I imagine this will become more of a global effort over time because it's not unique to the US. So those are two areas, and I do think they're pretty important to get right. We rely a lot on data, storage, security, processing, and it's getting funneled through a potentially smaller number of providers, because there's economies of scale and network effects that could play in. So.
I wanted to pick up on Willem's earlier question. We could be living in a world of chronically low R star. Not quite sure whether we're going to go back to that world, in which case central banks would be back operating largely or quite often at least, at the effective lower bound. And then in a world where there's much more of a need and a usage of proactive fiscal policy. So a question I think mainly for Bill and Under Secretary Liang, what do you see as the implications of this shifting digital frontier, central bank digital currencies, et cetera, for the relationship between monetary and fiscal policy? And particularly from a sort of a design perspective, do we need to rethink the monetary and fiscal framework and how it operates?
Well, I think as we talked about earlier, it does open the possibility of significantly negative interest rates, which does have implications for monetary policy and worries about being pinned to the zero lower bound. Whether people decide to design a central bank digital currency to operationalize that potential or not, I'm pretty skeptical that I don't think that's going to happen in the first iteration, because I think it's going to be, one, very controversial. I think because now you're really merging monetary policy and fiscal policy together in sort of a maybe uncomfortable way. Yeah. And I think people are going to want to more get their hands around this thing that's a little bit better than cash, see what it can do before they start to embed in it a whole bunch of other functionalities. That's my view. Nellie?
Yeah, I don't think technology changes the need for an independent monetary policy from fiscal. I don't think the technology changes it. I kind of think of the technology that could make both of them maybe more efficient, certainly on the fiscal side more. Even designing programs, even the payments, the actual payments being made. Like Treasury now has this big initiative called payments integrity, which is to get the right amount of money to the right person at the right time. They're going to be able to use some of these new digital innovations in ways that really improve, the performance of that. But I don't think it fundamentally changes what kinds of fiscal policies we would take, at least not in this foreseeable iteration or two. And beyond that, I'm not willing to venture.
Do we have time? I think this is the last question. So, okay.
Thank you. Neha, you raised an interesting point about the public and private partnership. In the innovation point of view, how do you eliminate the bias while creating the innovation, especially on the AI and what's happening in the last few days on the breach of trust? Going forward, when you raise the question about 50 years to 100 years, how the central bank existency, even the next year or two, how the AI innovation or how do you eliminate the bias in creating those innovations?
Yeah, I think that's a very challenging question. I would turn back to sort of the Undersecretary's comments about how the public sector gets involved. When the executive order on AI came out, it was clear there was a lot of collaboration in that, and that's incredibly important. I think I agree with the statements about the public sector setting sort of the rules and the guidelines and allowing the private sector to innovate within them. I think where it gets really challenging is when innovation forces you to completely rethink and rewrite what you thought were the rules of the road or the way the road worked. The physics changes. The physics of the way you drive changes, and which will happen. It's a given that it will happen. Maybe not frequently, but we will. Innovation does not stand still, and we will constantly be updating the way that the knowledge that we had, the ability with which we're able to do things, the scale at which we're able to do things. So I guess the only thing I can say is dialogue. Dialogue is so incredibly important between innovators and between the public sector. Right, so I think we're at time now. So thank you. Join me in thanking the panelists for this great panel.
I think we would all agree this has been a very robust and viable and valuable program, so I will be very brief in the closing. Before we adjourn, I must thank everyone who made our inaugural session on exploring innovations in central banking conference here that we've done a success. On that note, I want to start by thanking President John Williams and all the Federal Reserve staff of the Bank of New York for partnering with us in this first event. They're a great group to work with, and we thank him very, very much. The issues featured today throughout the program made it clear that the role of central banks will only become more important to the future of financial stability. Well, you kind of wonder, if we get into an AI cryptocurrency world, what the role of central banks is going to be. That still was left open, I think. BWC is looking forward to continuing the partnership with the Federal Reserve Bank here in New York and continue the conversation about these key issues and the role it plays. With that, I would like to invite Harry Patak, Head of International Policy and Strategy, who helped organize this event at the New York Fed, to give us the final closing remarks. Harry, and thank you for running this and organizing it.
Thanks so much, and thanks to the BWC for partnering with us to host this event, and to the panelists and the moderators for all of their insights and their perspectives that they shared today, and of course to the audience for attending and for being very engaged and asking some very provocative and interesting questions. My comments today reflect my own views and not those of the Federal Reserve Bank of New York or the Federal Reserve System, and I'll use my comments to kind of summarize some of the takeaways, some of the things that we heard today. So some of the high points on the first panel were really around addressing financial stability risks and monetary policy in times of crisis. And so there, one of the things that a lot of the panelists discussed and talked about was the importance of identifying emerging vulnerabilities. So as the financial system innovates, what new vulnerabilities could arise, to sort of assess those vulnerabilities on an ongoing basis, and also to think about ways of addressing those vulnerabilities. And when it comes to addressing those vulnerabilities in crisis, it's not just about the availability of tools, but also about the operational readiness of market participants when it comes to availing themselves of those tools. On the second panel, which just concluded, I think a lot of the panelists discussed this idea that there were opportunities and risks associated with innovation. And specifically on the idea of CBDCs, there was a robust discussion on how the design of CBDCs and their use cases were going to differ a lot across jurisdictions, and that the goals of CBDC rollouts could differ a lot among different countries. And finally, on rules and regulation, one of the points that came up in the second panel was that the existing rule set may not apply immediately and perfectly to new financial innovations, and that there's a need to sort of look for those gaps and address those gaps where appropriate. And that comes down to, I think, the reason that we're all here and the value of international cooperation, coordination in protecting sort of global public goods. So a couple of the themes that came out, I think, were the importance of communication among central banks, including at international fora, to sort of continue open dialogue, and coordination beyond just technology, coordination on global principles to focus on outcomes. So those are some of my takeaways. I hope you all had a good time and enjoyed this discussion, the conference. I have two administrative notes before we conclude. The first is we're going to head to lunch now. Lunch is going to be on the first floor in the Liberty Dining Room. If you checked a coat or checked a bag on the 12th floor when you came into the auditorium, please collect them on your way out the door so that you can take them down with you. You won't be able to come back up to the 12th floor to take them after lunch. So with that, thanks everybody.